Welcome back, Focus Learners. Okay, today we are diving into an explainer that is honestly going to fundamentally change how you look at your trading dashboards at the end of every single week. Look, we all want to know if we're actually getting better, right? But the tool almost everyone uses to measure that is completely flawed. So today, we're tearing down the old way of reviewing trades and discovering a whole new behavior-based system.
Okay, let's dive into this by asking what seems like a totally obvious question. Is a green week always a good week? Almost every trader is conditioned to nod their head and say, well, yeah, of course. We've been taught from day one that a positive profit and loss equals trading skill. But today we're going to challenge that deeply held belief. Because the truth is, a green week might just mean you got really lucky while making some downright terrible choices.
Here's a quick roadmap for today's explainer. 1. Why P&L lies to you. 2. A tale of 2 trading weeks. 3. The 4 behavioral metrics. 4. Beware the slow drift. 5. Redefining a losing week. And 6. Building your weekly routine. All right, let's jump right in.
Section 1. Why P&L lies to you. Here's the harsh reality. P&L reflects the market's cooperation just as much as it reflects your actual trading process. Think about it for a second. You can close a week up 8% purely because the market happened to aggressively trend exactly in your direction. Meanwhile, behind the scenes, your risk behavior was quietly deteriorating. You were jacking up leverage, widening stops out of sheer fear, or maybe dumping all your capital into one single symbol. If you carry that exact same degraded process into next week and the market decides not to cooperate, you are looking at a completely catastrophic loss. Which brings us to an absolutely crucial philosophy for this explainer. A green week built on rising leverage is a worse week than a flat week built on consistent sizing. Using P&L as an emotional scorecard is incredibly dangerous, guys, because if you only look at the dollars you made, you are completely blind to the massive risks you took to get there.
Section 2. Tale of 2 trading weeks.
Now, what's really interesting about this is when we look at a concrete case study. Let's take a single trader over 2 very different weeks. Take week 1, for instance. 5 trades, average leverage is a solid 5x. Every single position carries a stop loss, and the largest position never exceeds 20% of their margin. They finish the week up a very respectable 3%. Now check out week 2. Average leverage climbs to 9x, one position is completely missing a stop, and the largest position eats up 44% of their margin because they stubbornly decided to add to a loser. But hey, they end the week up 6%. Purely looking at the P&L, week 2 looks like a massive improvement, right? I mean, they literally doubled their returns.
But let's flip the script for a second. If you evaluate this purely on risk behavior rather than P&L, week 2 is a ticking time bomb. Leverage almost doubled. A stop was totally dropped. Concentration more than doubled. A behavioral risk report flags this whole week as a massive warning sign where the account took on insanely elevated risk just to produce a similar-looking dollar result.
Section 3. The 4 behavioral metrics.
Okay, so what should we be tracking? Metric number 1 is average leverage, specifically your notional weighted leverage. If this number is rising week over week, that is a glaring, flashing red light signaling growing risk. And listen, it does not matter if your P&L is going up or down. If your leverage is climbing, you've got to catch this before the market brutally punishes you for it.
Metric number 2, stop loss coverage. This just tracks the percentage of your positions that actually have a live stop in the market. Dropping your stops is a severe discipline warning. And again, this is completely independent of whether the trade ultimately wins or loses. If this coverage number drops below 100%, your process is leaking, period.
Metric number 3, position concentration. This looks at your largest single position size. Rising concentration means that one single market move now controls a massive chunk of your account. Whether you got there by initially oversizing or by stubbornly adding to a loser like we saw earlier, high concentration creates a literal fatal vulnerability in your portfolio.
And finally, metric number 4, revenge trading. This flags trades opened within 15 minutes of a prior loss. It's an incredibly common trap. We've all been there. But a rising count here tells you that you are trading emotionally. You're rapidly firing off orders just to chase losses. This specific behavior can destroy an account in a single afternoon, so you absolutely have to catch it early.
Let's move to Section 4 and see how this builds. Beware the slow drift.
So let's observe this concept of the slow drift in action. In week 1, your leverage is at a totally reasonable 5x. Week 2, it creeps up to 6x. Week 3, 7x. By week 4, you're at 8x. Day to day, you probably don't even notice this is happening. But a leverage number that creeps up just 1x every week for a month is a much bigger, more terrifying warning than any single random spike. Small, quiet increases in risk accumulate fast.
Look, a single week's data can be noisy. We know that. But 3 to 4 consecutive weeks of the exact same metric moving in one direction, that is a reliable, undeniable signal. It is the core diagnostic warning sign. You desperately need to tell you that a bad habit is forming.
Section 5. Redefining a losing week.
We have to fundamentally reframe how we view losing weeks. Contrast these two scenarios. First, you have a good red week. Your leverage stayed steady, every single position had a stop loss, and your concentration stayed beautifully low. You lost money? Sure, but your behavior was incredibly disciplined. You just simply ran into an unfavorable market. Now look at a bad red week. Your behavioral metrics drifted. You started adding size or jacking up leverage, trying to force the market to give you your money back. Make no mistake, only that second scenario actually requires you to fix your process.
Because if you don't separate those two scenarios, you fall into a really dangerous trap. Treating every red week as a process failure pushes you toward the exact toxic behavior this explainer is meant to help catch. Seriously, punishing yourself for a perfectly disciplined loss is practically begging your brain to start revenge trading the following week just to quote-unquote make up for it.
Section 6. Building your weekly routine. Let's run through the super common pitfalls traders make during weekly reviews. First off, judging the week solely by ending P&L. We just covered why that's a disaster. Second, only comparing this week to last week. That makes you completely blind to that dangerous slow drift we talked about. Third, and honestly this is a huge one, skipping the review entirely after a losing week just because it feels uncomfortable to look at. And finally, reviewing only closed trades while ignoring currently open positions that might be carrying severely elevated risk into Monday morning.
So the crucial point here is that you need a system tracking your actions, not just your dollars. A platform like DRKN actually surfaces these exact account-level comparisons from read-only data to build a clear diagnostic picture. Now, it doesn't judge whether your specific trade thesis was brilliant or terrible. That is still your job. What it does do is hold up a mirror to your actual behavior week over week.
I want to leave you with a provocative thought to chew on before you place your very next trade. Are you evaluating your decisions right now, or are you just evaluating your luck? Because if you rely on P&L alone, you are only measuring luck. It's time to start comparing the actual behavior behind those numbers. Track your leverage, watch your stops, and manage your concentration. Because guys, that is how you truly know if you traded better this week. Thanks so much for joining this explainer, Focus Learners, and I'll catch you next time.